Hi, everybody, and welcome back to the BizBeat by SVA, where we bring business owners the news and insight that matter most for taxes, strategy, and business growth. I'm Lee Schwartz, Director of Business Development and Sales at SVA Certified Public Accountants, and joined as always by our tax principal and president, Eric Trost. Eric, how's it going?
It's going really good, Lee. I saw that now that we crossed the 500 listener mark, I feel like I owe something to our listeners personally, and so I'm going to share something about myself. I started a new diet.
Okay.
Yeah,
Is
and
is it is it moving away from all fast food barbecue?
uh, no, that I'm allowed fast food
Okay.
barbecue. I'm
Okay.
moving away from some carbs, and my goal is to get my weight with a 2 and a 3 in the front of it. And I started with a 2 and a 6. And which is great if you're a linebacker, probably not so great if you're a middle-aged accountant. And I'm down 10 pounds.
Nice
So
work.
it's working so far. I'm wondering if I should start documenting my weight loss right here on the screen with pictures or video that people can follow along, if that would help our viewership.
I not only would that decrease our viewership, I think, but I think it would. What about our just the people who are just listening and not watching us on YouTube? They're
Right.
going to feel all left out.
Going to have to vision it.
Yeah, all right, fair enough. We can paint a picture. What's when we get to 1,000? What the question is? What are you going to do for our listeners?
Yeah. I don't know. Some kind of feats of strength.
I like it. I'd like to see that. Okay. Well, so far very topical, listeners. You're getting all the information you need to know. But no, we do have. Before we jump in, we've got some good topics to cover today. But quick reminder: if you're tracking developments on the One Big Beautiful Bill, we're going to cover a couple things on that here today. But check out sva.com/OBBBA. Remember, 3Bs. That's where we keep updated resources, FAQs, upcoming webinars, recorded webinars, all that good stuff. So head over there and check it out. But Eric, let's start out here. Beginning of last month, we talked a little bit about Trump accounts, some conversations around what's better, a Trump account or a 529. Let's maybe set the record straight on where those conversations have gone and where your head is at as far as, kind of the pros and cons of what these Trump accounts are going to be.
Yeah, and I've had a chance to do some more research on them, and we've gotten more information come out on them. So I think we've got more of a handle on how these Trump accounts can be used. So I want to review the rules with them. The Trump accounts are establishable, so you can't open one yet. They're establishable starting next year, July. So basically, the law passed July 4th, 2025, the new OBBBA law, and it basically gave a year to get these Trump accounts, the structure in place, and give companies the rules to go by. And so next year you can open a Trump account. The Trump accounts, though, are available. They'll be funded automatically by the government for newborns between 25 and 28. So if you had a baby between 25 or in the future by 28, the government ultimately will fund the first $1,000. So they originate the account for you if you don't do it yourself. Even if you do it yourself, the government will still put that $1,000 in. What these accounts then allow for is for $5,000 contributions into the child's account that are post-tax contributions. So when you put the money in, you're not getting a deduction on your current tax return. That's different than an IRA or a 401k, where sometimes you can put money in and get a deduction. A Trump account, you get no deduction for the money going in. The Trump account then grows tax-free for the child until they turn 18. So you can't take the money out until they're 18. Once the child's 18, the Trump account effectively turns into an IRA. So the IRA is a tax-free growth account that can be taken out at retirement or before retirement for certain items. And you won't have a penalty when you take it out before retirement, as long as it's for certain exceptions. Some of those exceptions are up to a certain amount for education, buying a house, medical expenses, loss of a job. So there are places that money can be taken out, but it's not a free for all. There was a previous rule that it could be taken out to start a business. That actually is not a rule now. That was an old account rule. And so I think I've mentioned that before. Cross that off the list. You cannot take it out to start a business without incurring a penalty. So there are things you can take it out for. When you take the money out after a child turns 18, or when the child takes the money out after they turn 18, it is subject to tax on the earnings, but not the base amount that's put in.
Okay, so right now, if you're a business owner, and let's maybe take a step back. I know we've got clients, Eric, who they're business owners. They might employ their children to work in the business before they're really, before they're 18. They've historically used that as a sort of funding mechanism for savings for their kids as well. Maybe talk about that a little bit, and then we can bring it all together and talk about how all of these things interplay.
Right. So um, one of the things that a Trump account requires or doesn't require is earned income. An IRA or a Roth IRA does require earned income, but there are some benefits to, say, Roth IRAs. And exactly what you were talking about is, let's say that a business owner employs their kids and pays them a certain amount, so that the kid has earned income, but not enough earned income to pay taxes on. So the kid has earned income, not enough to even file a tax return. But then a Roth IRA deduction or Roth IRA account can be created on behalf of the kid because they have earned income. So what can happen is, a parent can use their business to pay a kid and fund a Roth IRA, which grows tax free also. The benefit of a Roth IRA is that it's never taxed on the earnings as long as it's taken out starting at retirement. So there is a tax free growth and a tax free distribution that comes with a Roth IRA. You'd want to use that instead of a Trump account, probably, if you could, except there is that rule that you need that earned income for a Roth IRA. For a Trump account, you don't need any earned income. So let's say you have a 3-year-old child, you can put $5,000 in a Trump account. It's unlikely your 3-year-old is going to have earned income or can contribute anything to your business of value that the IRS would respect at that age. So maybe starting very young, they have Trump accounts, but if you have a business and you employ your kids, at some point you want to employ your kids and do Roth IRA contributions. And I think that beats what a Trump account, the benefits a Trump account offers.
Okay, so and there are going to be other pros and cons as well, but what I'm hearing you say is, especially when your child is very young and unemployable, essentially, which I mean, come on, start earning your keep. But no, once they are when they're young, that's when the Trump accounts definitely make sense, earning vehicle for them. As they get older, as you start thinking about college and education expenses, and maybe employing them in the business, then all these things are going to interplay together. And that's where you really got to start strategizing a little more.
Yeah, that's right. And remember, this country does have child labor laws now, Lee. So, in general, there are some rules around kids working at a certain age. I think it's 5.
That's ridiculous.
They're
That's
freeloading from 0 to
they
5
are.
is
I
what's
know my
happening.
kids are freeloaders. I can tell you that for sure. Okay, so let's move on, Eric. Last week there was some new guidance issued by the IRS on R&D expenses. We've talked about R&D in the OBBBA bill, but talk to us about what has changed, or at least what's been clarified.
Yeah. So, just a recap of R&D expenses. Where we were from the original Tax Cuts and Jobs Act, that was 2017, was that R&D expenses would, starting in 2022, no longer be immediately deductible. So R&D expenses, if they were domestic, starting in 2022, were going to be deducted over a 5-year period. If they were foreign R&D expenses, they were going to be deducted over a 15-year period. And so that rule has been in place now since 22, 23, 24, until this the new law, the OBBBA law, on July of 2025. What the new law says is R&D expenses are once again deductible, fully deductible, starting in 2025. Small businesses now have the option of deducting those expenses, going back and refiling returns from 2022, 23, and also 24. Even if they filed their 24 return, they can file what's called a superseded return and take those expenses. What the regulations clarify is the process on how to do that. So the IRS just released these regulations last week, Friday, and those regulations lay out the procedure to go back and take these expenses for small businesses. One of the things that the regulations discuss is if you elect to take the expenses in 2024. So let's say you haven't done your 2024 business return yet, and you might not have because they're not due until September 15th. You can deduct those R&D expenses now in 24 without having to file a return and do an amended return or a superseded return. You can just do those expenses on your original filed return. But then that does lock you into that treatment for 22 and 23. So right now, and there might be more guidance that comes out on this, but right now our understanding is if you elect to deduct those expenses as small business in 2024, then you have to go back and amend 22 and 23 to deduct those expenses as well. You can't keep amortizing them from then. You can't take them in 2025 as a catch up. So the rules are a bit strict on how you go back and take those expenses if you're a small business. And a reminder, a small business is under $31 million in average gross receipts.
So, Eric, if you're a $20 million, if you're under that threshold and you've got some pretty significant R&D expenses, as you look at this now, and I know this is new, but as you look at this now, what would be your recommendation to a company in that situation?
Yeah, so we're talking to a couple of them right now. And one of the companies said, we don't want to go back and amend 22 and 23. We're a partnership. We have a lot of partners, and it would be somewhat of a compliance hassle and a investor disruption. And so they're not looking to do that. So they're not going to take 2024 expenses either, because if they took the 2024 R&D expenses, they would have to amend 22 and 23 to take advantage of the deduction. So they don't want to do that. They're going to take 2024 and treat it under the old rules and deduct those expenses over 5 years. What that means is they're going to allow 22, 23, and 24 expenses to continue their 5-year amortization schedule as if the new rule wasn't in place. And then starting in 2025, they're going to deduct 100% of their R&D expenses. So that's one option that they're looking at doing. The other option, though, that some other businesses are looking at is they do want to refile. They want to grab those R&D expenses in those years, get refunds from those years, and make sure that they're getting full R&D deductions for 2024 and then 25 and going forward. So those businesses are going to go back and do the amendments. One of the things you're looking at when you're making decisions about when to take a deduction. And so now the IRS has opened these possibilities. Not only can you go backwards, you don't have to go backwards. You can, in 25, just do a big catch up of all previous expenses you have not taken. So you can do that big catch up. But what you're looking at is when do I want my deductions to take place? And that's a function of what tax rates you're in when those deductions would take place. A tax deduction that takes place when you're in a 37% bracket, a dollar's worth 37 cents. A tax deduction that takes place when you're in the 15% bracket, that's worth 15 cents. So when you're timing out when you choose to take deductions, you're looking at tax rates and trying to maximize the benefit of those. Because a dollar deduction is a dollar deduction, but it could actually mean 37 cents in your pocket, or it could mean 15 cents in your pocket. What you're looking for is to maximize the benefit of those deductions.
Right. And part of that calculation, too, is what's it going to cost you to amend and refile and do all that stuff, right?
That's right. That's right. There's a compliance cost to go back and amend and refile. And, then you're opening those returns into human hands, and it goes through an IRS processing system. And the IRS is not right now on the ball on some of these things. They're a little bit short-staffed, if you've heard.
Yeah, we've talked about it here.
That's what they claim, is they're short-staffed. The
Yeah.
governments might say on some sides they have the right amount of staff. They just need to work more efficiently. So there's two
Yes.
sides to that story.
There's two sides to that story, no matter where you're talking about.
That's
So,
right.
all right, Eric, let's move on to the inbox. Just a reminder, you can email us your questions to bizbeat@sva.com, or you can fill out a form on our website at sva.com/bizbeat. This week's question, Eric, is really real estate focused. So, can you briefly explain what a 1031 exchange is? I have a property I want to sell and would like to see if it makes sense for me. So, yeah, I guess great if you can give us a good overview of what that means.
Sure, I'll give you the basics of 1031 here. Essentially, what this code section allows for real estate, so investments in real estate, is it allows for a person to sell their investment in real estate and take the proceeds and put it in another investment within real estate and not pay any tax on the sale. So there's not a lot of places in the Internal Revenue Code where you're allowed to take income and roll it into something else and not pay tax on that income. Usually, when you have income, you pay tax on it. This is one of those exceptions. So it's a very taxpayer friendly code section. Now, there's some strict rules on this. One is when you sell this property, original property you sell, that money has to go into a trust account. So it goes into a qualified intermediary, it's called, goes in an escrow. And within that escrow account, it cannot be used by you. So essentially, it sits there until the new property is found, and then it can be used to buy the new property. You cannot do a 1031 exchange if you make a sale and take the money and put it in your bank account. You've already violated it. So don't go to your tax accountant after the sale and say, I'm interested in a 1031 and I sold this property yesterday or 6 months ago. It's too late because at sale, that money has to go into an escrow account. The second rule is you have 45 days to identify properties that you want to buy. So essentially, when you sell, you really have to already be thinking of this is the kind of property I'm going to buy, or here's the property I'm going to buy. Because when you identify that property, you're identifying specific addresses, not some general, I'm going to buy investment property and that's my identification. You have to identify by listing what the address is or some specific marker as to what that property is. So I'm going to buy, 3545 North Center Avenue. So if you're going to buy something like that as a replacement property within 45 days, you have to make your identification to the company that's holding the escrow. And the last is you got to close within 180 days of your sale. So from the sale of the original to when you purchase the new property, that total is 180 days. So there's the money held requirement. That's got to be in an escrow account. There's the 45-day identification period requirement, which is you've got to identify what property you're going to buy within 45 days of your sale. And then there's the 180-day acquisition requirement, which is 180 days after you sell your property. Within that 180 days, you have to close on the new property.
Okay, so a lot of rules there. And then one of the other things, Eric, I hear all the time, because I often hear this referred to as a 1031 like kind exchange. Can you talk a little bit about what like kind actually means? So, like, can you sell real estate and then, as long as it's within those timeframes that you talked about, can you, invest that into a business, or what does like kind exactly mean?
Yeah, like kind generally means like real estate for real estate, but there's some flexibility here, such as you can take a apartment building, sell that, and invest in commercial real estate that is it's non-residential. So you can take different kinds of investment real estate and sell that and invest in other kinds of real estate. We have some clients that they get to the end of their wanting to manage residential real estate. Say, okay, we're going to sell this. How do I avoid my gain? They want to take those proceeds and they're going to 1031 exchange them, but not into other residential real estate because they want to get out of that active management. They roll them into things like the Walgreens stores or the Dollar General stores. So they roll them into real estate, but it's not residential real estate. And it's not even real estate they have to actively manage. These are triple net leases kind of real estate that they roll it into. So there's a lot of flexibility, but it's still real estate for real estate. It's got to be an interest in real estate, not a new
Okay.
business.
Okay. And really, I mean, this is, you're avoiding the taxes at the time, but at some point, when you stop, you can keep parlaying that and doing 1031s, but at some point you're going to have to pay taxes on this.
Unless you die holding it.
Oh, well, there
The
you go.
ultimate tax planning sacrifice. Just pass away while you're holding those properties, and then they get a step up in basis, and then taxes never paid.
Okay. Well, there you have it. I know that's something our real estate investors ask about a lot, and thank you for going through that, Eric. That's going to be it for this week's BizBeat by SVA. Don't forget to check out sva.com/OBBBA for our latest resources on the One Big Beautiful Bill. And as always, as I've mentioned the last couple months, if you are part of an organization that wants a presentation on how this is going to affect your membership, we would be happy to do a presentation for you. Also, remember, subscribe on Apple Podcasts, on Spotify, or on YouTube, and share this episode with another business owner in your network. We would appreciate it. Yeah, we're at 500, but we want to be at 5,000 and 5 million. We're going to take over the world. Joe Rogan, here we come. Okay, and just listen, a reminder, as always, what we share here is general information. For advice specific to you and your business, please speak with your advisor. And as always, if your advisor isn't SVA, reach out to me. Let's fix that and make you a client. Thanks for listening this week. Have a great rest of your week, and we will see you next week on the BizBeat by SVA.
It's the BizBeat by SVA, breaking down the news of the day. From tax tips to business trends, smart insights from trusted friends. The BizBeat by SVA.